psychology of market timing is crucial for market participants to be aware of so that they stand a chance of being able to make the right tactical moves at least some of the time. Hey, everybody, Serge Berger here, your host of the Steady Wealth podcast. Hope you guys are all doing well. In full disclosure, it's been now, I think we're at month 15. And I think I finally figured out how to use all this technology here properly, which is also why I'm wearing a headset. Anyway, one thing also I'd like to mention before we get started and looking at the market psychology of market timing, if you guys have any inputs, any things you'd like us to talk about the markets, any individual sectors, stocks, styles, managers, anything really, we'd be more than happy to entertain that and see if we can help you out further with insight into the markets. So let's talk about it. Let's get right to it. And what we're going to talk about here today is the psychology of market timing. Now, when it comes to market timing, I always like to really be very clear that I believe that trading and investing is to be separated in multiple timeframes, multiple buckets, meaning that the investing bucket is for most investors probably going to be 80, 70, 80, 90 plus percent of their investable assets, meaning investment timeframes where a sort of diversified portfolio is at the core of an asset allocation strategy. Now, of course, there may be other assets as well, such as real estate and other assets included in that bucket as well. The rest of that money, though, and if you're listening to this podcast, you most likely have an interest in at least doing some trades here and there. Just we want to caution to make people understand that being a trader doesn't mean that has to be done with all the money. In fact, again, this is not advice and everyone's got a different portfolio and risk parameters, but anywhere between maybe as little as a couple percent up to maybe 20, 30%. Again, everyone's different. Of one's investable capital should be at most put to trading use. And that also gets us right into the market timing aspect of it all. I have a couple of charts I'm going to show you guys as well. And again, for those people that are listening just on audio, as always, I'm going to just let you know right now, you're not going to miss anything. I'm going to describe the charts just as well as we go through this. But I think the psychology of market timing is really fascinating because when we think about, there's multiple factors that drive lots of self-directed investors to basically buy and sell at the worst possible moments. And I'm going to show you guys the charts of how badly and self-directed investors actually tend to do, or even how badly some of the professional investors tend to do who try to do that with too much capital. And again, we're always saying there's a bucket for that, for the market timing, for the more proactive trading stuff. But again, it, in our view, should be used in conjunction with a diversified portfolio. So one of the core issues, of course, when it comes to market timing and the lack of being able to really ever make any money over time, and this is not to say one can't have a successful trade here and there, it's about over time. The issue really is that fear and greed come into play. And I think that should be of no great surprise to anyone. We are emotional creatures as human beings. And if you think about this, I just recently went on a couple of big roller coasters over the summer. So I've been watching all these roller coaster videos on YouTube that pop up. It's funny how that happens, right? You talk about something, whatever the topic is, and all of a sudden you go to your YouTube or whatever, and all of a sudden, because someone's listening, at least apparently that's the case, all sorts of videos and ads tailored to your topic tend to be popping up. Anyway, point is roller coasters, right? So if I think about the dynamic of roller coasters, which I've been looking into a lot more since these roller coasters this summer, it's just when you get to the trough of the sort of the drop, it obviously tends to go back up. And the problem is, if psychologically and also the way our mind works is it's like our mind actually thinks it's going to keep going and going, but just at the absolute worst moment where we're basically giving up and freaking out, starts going back up. And it's the same thing for investors who try to time the market. We have found that lots of people either are too premature in getting in and out of positions, or they just wait too long. And again, a lot of it has to do with fear and greed. So let's talk about the fear part first, emotions versus reality. So I think at the end of the day, when we look at let's say I buy a stock, let's say I'm investor XYZ, or trader XYZ, maybe more in this case, and I buy a stock. What we know for a fact is that the worst I can do is to lose all my investing principal that I invested in that stock. It can't go more than zero. I specifically said stock, right? I didn't say use derivatives where you can actually lose more than that. You can't lose more than your invested capital. So rationally speaking, if I'm comfortable with the risk I'm taking, if you think about the absolute worst case scenario, let's say I invest $1,000 in a stock or in a sector because I think it's about to turn back up, let's say. The absolute worst that I can lose is $1,000. What we find, though, is where people get into trouble with the emotional side of things is because they invest too much. In fact, just the other day, spoke with a client who was, I think, oversizing his position just in the day trading account. And it sounded like he was getting a little bit nervous. And I had to step in there and just make sure that the positioning wasn't way offbeat. And sure enough, it probably was, right? So we have to think about that. So I guess that's the greedy part. It's fear as well, but the greedy part is also in the same topic because what ends up happening is because we're greedy, in this case, we're oversizing a position, it quickly turns into fear because if a position goes against us, we're then quickly seeing how much money we're losing. And what tends to happen is that we sell at the absolute worst moment. And again, a lot of it is because what a lot of market timers tend to do, novice market timers, not professionals as much, is they look at an absolute level on a stock where they're going to be proven wrong, and even worse, whereas there needs to be more than that. That's a single factor analysis. So let's say they buy a stock at $100 and they say for whatever reason, whatever random reason, it may be very random, meaning I'm going to say I don't think it's going to drop more than 10%. That 10% number may be irrelevant for the stock, for the news flow, for the fundamentals, for the technicals, for whatever. There's really no rhyme or reason to use that stop. And it's just a number. Now, of course, if we have that number, we should stick to it for the most part. But if it's so arbitrary, then we might as well not put on the trade, right? So then the trade is being put on out of fear of missing out, FOMO, which is another element of fear and greed. But let's get back to the positioning. What I hear a lot of people do is, let's say they invest $1,000 and they're saying to themselves, I don't want to lose more than $150. And they will set their stop in that position according to that limit. Again, that may be a completely useless number to use because we don't know what that corresponds to on the charts in terms of if it's a technical level that may be important where that stock has now dropped 15%. If you think about $1,000 and my stop is 150 lower, that's 15%. Or again, whatever other, is there an earnings report in between, like all those kind of things have to be taken into account. So if all I'm doing is saying I don't want to lose more than $150 and that's where I set my stop, again, it's probably not worth putting on the trade. There needs to be more stuff done. So these are the kind of the pitfalls that market timers fall into. So the timing, the timing the market, and it really is a difficult thing to do for more than a trading account. So I will always advise people against market timing with their entire nest egg. And we see actually lots of retirees that do come with at least some of that attitude to us. And this happens both at the Steady Trader, our research firm, a publishing research firm, and then of course at Blue Marlin Advisors, where we actually invest money for them and actually give the investment advice. So we see that on both sides, where retirees or people that are going to retire at some point over the next 10 years, they have this idea that they're going to become these market timers. And more often than not, they tend to want to do that with way more money than they probably should. Again, everyone's got a different risk parameters and account size and so on and so forth. And so before we continue into this and look at the behavioral of this, and again, what the topic here is, just to bring it back, it's the psychology of market timing. Why are we doing it so badly? A lot of it has to do because we're setting arbitrary stops that are largely based on just completely arbitrary numbers. So investors tend to sell at the absolute worst moment. And by the way, this holds true for investors too. A lot of investors who don't have diversified enough portfolios, and diversification, I don't mean diversifying among one asset class, different asset classes, different parts of the asset class, right? So if you talk about stocks and bonds, there needs to be a diversification among different assets. First of all, between stocks and bonds, not just one asset class, but also among different stocks and among different parts of the yield curve and that kind of thing. That's true diversification. And then, of course, one can diversify in many other ways, right? Going with different asset classes, for example, real estate, and so on and so forth. So before we look at this a bit more in terms of what the damage can be, let me just bring up a chart. And this is where I'm going to quickly flip and share the screen. Again, if you're not watching this on YouTube, you're not going to miss anything. I'm just simply going to describe what this chart is. So give me just 1 second. Let me see if I can find it. It is this one here. So the first chart I'm going to show you here is one that I basically show every single prospect that I speak with at Blue Marlin Advisors, our investment advisory firm, to get their head around just how difficult it is to try to beat the market. The market being, let's say, a broad asset allocation to equities and fixed income. And so what I like to show them is this chart where what the chart shows, it's a bunch of bars. And what it shows is that between 2001 2020, that 20-year stretch, the average investor, and this is relating to a lot of self-directed investors, has made about 2.9% per annum, 2.9%. A typical 60-40 portfolio, 60% equities, 40% bonds, made about 6.4%. Okay. And the S&P 500 made 7.5%. First reaction of many novice investors, well, what the hell? I just buy the S&P and call it a day. Probably wouldn't be that such a good idea, because what's not being accounted in this calculation is the volatility. The S&P 500 has had a tremendous stretch of returns over the past 12, 13 years. And equities alone, like no diversification away from equities, basically means a lot more volatility. So just because the S&P in this case made 7.5% per year versus a 60-40 portfolio making 6.4% does not mean that equities is, and only equities, S&P 500 centric allocation is the thing to go. Also, history doesn't repeat itself. So we can see, just because every year equities have done well for a long time now, almost every year for 12, 13 years, doesn't mean that's going to happen for the next 5, 10 years. In fact, I think the next 5 to 10 years, we're going to see much more difficult for equities to navigate through as an asset class, particularly US equities. So just wanted to show you that. The other thing I want to show you, so the average investor is trying to do it themselves. And there tends to be a lot more micro timing with that. Again, they dramatically underperform. You can see they do less than half the returns of a 60-40 portfolio. That's pretty bad, because they mark basically market time. The other chart I want to show you here, and again, I'll describe this for anyone listening on audio only, which is probably the majority of you. This just shows how many professional investors actually underperform the index. So over a 15-year period, basically 90% of managers underperform the S&P 1500. So this is like on all equity index. Over a 1-year period, it's about 71%. They tend to do better versus medium and small caps because there's a lot more single stock picking there, but then there's also a little more volatility. So anyway, long story short, the one takeaway I want you to take from here is just an all equities portfolio is that US equity managers underperform. 90% of them underperform just the broader indices because it's that difficult to market time. Now, again, as I always have to say, this is not at all to say that one shouldn't do trading at all. Obviously, I trade every day, and we have an entire business based upon research on that and signals and everything. But I just want people to know how difficult market timing can be. The more money we do it with, and I don't mean an absolute dollar amount, but the more money of ours, like percentage wise. So let's say 100% is my money. If I do it with 10% of my money, I have less mental strain than if I do it with 20%. For most people, right? If I do it with 2% of my money, I try to market time. A lot of people don't even barely notice that, because and of course that can have another aspect to it, which is then if they do it with too little money, they may not take it serious enough. We see this a lot, right? So the market timing in general, psychology here is that it tends to backfire for a lot of people because it's easy to find all sorts of case studies that pretend that market timing is easy. And it may be doable. It is, I would argue, doable with smaller amounts of money in terms of percentage of our total assets. And so this is also where investment advisors come in, right? And this is just one of those things. We know that people who use investment advisors tend to do better than if they do it themselves, even if the investment advisor doesn't give that person great investment advice and just keeps them allocated to diversified portfolios. What an investment advisor can do, it's like a coach. He can keep the client from doing something silly, right? Trading too much, taking too much risk, right? I think that's an important point. An investment advisor doesn't have to make you 30, 40% a year. And if he does, that comes with a lot of risk, right? There's no portfolios out there that have no risk, that have the potential to make 30, 40% a year. But an investment advisor, even if they're not an investment advisor that is really good at investing, right? Even if they should be there as a coach to hold the investor's hand, keep them off the ledge, right? And keep them focused on the long-term goals. And yes, by all means, let them trade, but let them trade with parts of their money. So at the end of the day, I would like to empower and self-directed investors to do their thing. But I also think I would empower everyone to seek professional advice for diversified portfolios, because market timing is difficult. So the psychology, we are human beings, we're emotional. I'm emotional. Everyone listening to you has emotions, right? It's normal. So market timing, the psychology, the reason why people don't make it work, in summary, is because it's difficult, emotions get in the way, and for a lot of people, they do it with too much money. I would argue that there is a part of many people's portfolios, particularly if you're listening here, obviously you're a self-directed investor to some extent. There's a lot of reasons to do some market timing, do some trading, try to maybe get into a sector, get out of a sector. But again, I also think for almost everyone, that should not be something that's done with almost all their money, which we do see some people trying to do that. Right? So don't get blinded by the typical advertising that we see, that how easy it is and everything. And it's all okay if we use some of our money. The problem is if we make that our one obsession and we have to make who knows how much money, X% of money, which by the way is another point, right? And I think that's really important. Maybe we should end on this one. Lots of people have some sort of a percentage return that they have in mind that they need to make every, God forbid, month or week. We hear this a lot, right? And they say, okay, I have to make $1,000 a week to pay whatever. Not only is that unreasonable in terms of the specific amount, it's unreasonable to expect that to happen every single month, because it puts tons of pressure on us. And if we don't understand that the markets are much more fluid than that, it can very quickly lead to some pretty big disasters. So I hope it's helpful, folks. Again, market timing, something that we have to be aware of our human psyche. It's difficult because we tend to sell at the absolute worst time and buy at the worst time. Remember, buying at the worst time is basically FOMO, fear of missing out. We've seen quite a bit of that this year in 2023. In fact, just as I'm recording this here, we just had it again in some tech stocks just the other day, where people are buying the absolute highs and then they're left holding the bag. And I can almost guarantee you when those stocks are ready to bounce again, they will have sold. Right? So it's just one of those things where human psychology is an important thing to keep in mind when it comes to trading and investing. Hope it's helpful, folks. Again, any feedback you have on the podcast, things you would like to hear us talk about, guests you would like to potentially interview, if we can get them, right? And if you're asking me to interview, I don't know, a celebrity, that may be more difficult to get to, depending on if it's an investing celebrity, it might be possible. But any topics, these podcasts are here for you so that you learn something, that we can address questions that pertain to you, your portfolio. Remember, we can't give investment advice on the podcast, but we can certainly talk about ideas, thoughts, processes, charts, all sorts of stuff. Thanks for listening, and we'll see you again in the next Steady Wealth podcast.